Boeing's up 11%, and we got, as Jim said, Nasdaq all-time high. Let's get to Bob Pisani.
You know, this is a remarkable rally, and we've seen the same thing, Carl, that's happened the last week and a half, and that is underperforming groups outperforming today. So energy stocks are up. Bank stocks are up. And once again, mega caps, which really led the rally, frankly, are underperforming. But I don't want to kid anybody. If you look at what's really going on, I tend to look at the market from where it was from the 52-week highs in February. And if you look there, you can see that this is still largely a mega cap driven rally here. So if you look here, Apple's essentially at a new high. Let's not quibble about a few points. Amazon, 1% away. Microsoft, 1%. Facebook, 4%. Alphabet, 6%. Remember, the S&P is 5%. From a 52-week high. That was on February 19th, of course. And, of course, you can see the effect this had on the other sector leaders. Obviously, technology and consumer discretionary, where you get the bulk of those mega cap names, technology is essentially at a new high. Consumer discretionary is essentially at a new high. And healthcare, which is the other market leader, is also only about 1% off of the 52-week high. So I understand that we've seen unusual sectors that have been laggards do well recently, but let's not kid ourselves. Yes, we've seen banks and energy rally, but energy is still 30% off its 52-week high. Banks are still 24% off, even with the big rally that we've given that's gotten so much attention in the last week and a half as we've shifted into these groups. Industrials are still 12%. Transports, which were part of industrials, 14% off. And the Russell, which we talked last week, had a terrific rally last week, is still notably lagging the S&P 500. So much attention is now focused on these underperforming sectors. There was a lot of debate back and forth over the weekend, a lot of notes flying around over the weekend. Mike Wilson over at Morgan Stanley is now changing. He's overweighting industrials and materials, those cyclical names. He's very big in them, and he's underweighting consumer staples and utilities. Sivita Subramanian, who's over at the Bank of America Merrill Lynch, was talking about value stocks over the weekend. Those are mostly banks and energy stocks, so they can differ in where they're going, but basically they're looking at the underperforming sectors and seeing if there's anything left in them. What's next? I think Jim had a great question. Where's the earnings? That's what we need. Let's just remind everyone what does drive the stock market here. It's earnings. Are they growing or are they not growing? And right now, they're not growing. They're going down. The estimates are still going down. How about dividends? That's the other thing that drives the markets. Are they growing or not? They're not growing. There are certain sectors that are cutting their dividends. How about the market multiple? Is it expanding or not? Well, here's the only thing in our triumvirate that's actually been expanding. This thing is way over 20 right now, and that's in historically overbought territory here. Carl, I want to remind everyone, 40% of the S&P 500 has withdrawn earnings guidance for the year. So Jim is right. What we need to have happen sometime in the next month, sometime in July, is some of these people, some of these CEOs who've withdrawn guidance come forward and say, hey, you know, I withdrew our guidance for the full year in April. Well, now it's the 4th of July. Now we have a better idea of what's going on. Here's our commentary. Here's our guidance. That's the next step. Jim's absolutely right. We need to see some expansion in earnings expectations and earnings guidance. Carl, back to you.